Yasmin, my go-to lender. Today, I really want to talk a little bit about each program of loans because I think that a lot of buyers get a little bit of a hiccup or don't know where to start, which of course we need a pre-approval before anything, but what does that look like? Is it a FHA loan, a conventional loan, VA? Do they need a jumbo loan? Like, what the hell am I even talking about? So this is this is right up Yasmin's aisle, and I would love for her to kind of give a snippet of each of those. I know that she could probably go into the weeds with all of them, but when you do speak with her, she can literally lay out everything that you are going to need when purchasing a home. So you're on.
All right. Well, let's chat about it. I say let's start off with kind of the basics. The most traditional loan is probably going to be your conventional loan program. On a conventional loan program, ideally on a purchase, you put down 20% to avoid what they call private mortgage insurance. However, you don't have to have 20% down, and it's not an ugly side to the loan if you don't have 20% down. So on conventional, you can put down as little as 5%. If you fall within the income guideline for the particular area you're looking at, there's an income cap. If you fall within that income cap, you can put down as little as 3%. So whenever you're putting down less than 20%, again, you get hit with that private mortgage insurance, but I'll tell you what, it's not that bad. It's not that ugly. They have really reduced the rates on their private mortgage insurance, and it's going to be based off of your FICO score. So if your FICO score is a 780, your private mortgage insurance is very minimal. If your FICO score is a 640, ouch, we'll look at your options from there. So then let's jump over to FHA. FHA is a government loan program, and they basically insure the bank in case you were to default on the loan. But what FHA does, it enables you to put down a very low down payment with lower mortgage rates. So FHA, your minimum down is going to be 3.5%, and your rates are going to be fairly lower than a conventional loan. So where's the kicker, right? If you have a low down and rates are lower than conventional, why would an FHA loan be better than conventional? Sometimes it's not, because FHA is going to try to get some fees out of you. So they're going to charge you an upfront mortgage insurance premium of 1.75%. So they charge you that upfront, but guess what? It's not out of pocket, it's financed. So it's added to your loan amount. That 1.75% is a percentage of your purchase price. So that's added to your loan amount, and that's how they make their money. They also charge you a monthly mortgage insurance premium, just like conventional. And most recently, over the past couple of years, they've dropped down their percentage rate on that. So the monthly mortgage insurance has come down. So again, not ugly. FHA is suitable for those maybe with not so perfect credit. You can go as low as a 550 FICO score in some cases, but also a person with an 800 FICO score would weigh out their options with FHA and look at the pros and cons between an FHA loan and a conventional loan. Then there's VA, another government program. The VA does insure the bank that they will get their money if you were to default. So that's what these government programs do. On VA, you are required to put 0 down. And there is no max loan amount. So with your 0 down, you can even purchase a property for $3 million if you can qualify with 0 down. And here's a kicker, there's no monthly mortgage insurance. VA does not charge you monthly mortgage insurance. However, they still want to make some money too. So they do charge you a VA funding fee. And that funding fee percentage will always be different depending on if it's your first time using the program, your second time using the program. It will be different if you decide to put down a down payment and put 5% down or 10% down. That reduces the VA funding fee. But again, funding fees, just like that FHA loan, it's not out of pocket. It's going to be added to your loan balance. So it's truly 0 down. And then ideally you just have your closing costs when you close on a VA loan. If you were discharged from the military disabled, that funding fee is exempt. And then if that was also the case, you and I could talk further because I can help you out with your property taxes, because there is an exemption on property taxes if you were discharged disabled as well. So we can go over that. Another program is going to be USDA. You don't really hear about that too much in San Diego, but we do have pockets. So if you made your way out to Descanso, or nice pockets out in Vista. USDA is another government-backed program that requires zero down, as long as the property is within the rural aspect of the program. So you can basically go onto USDA's website, plug in the property address, and it will let you know if that property is eligible. USDA focuses on rural properties. So basically a property that's just out in the middle of nowhere with ton of acreage. That's an awesome program, low rates as well. And then you've got your beautiful jumbo loan. So jumbo is going to be different for every county. Every county has a max loan limit. And if you're over the max loan limit for that county, you're considered jumbo. Jumbo does require 20% down. The only way to try to truly get around that is by doing 10% down and then taking a line of credit behind it. We call it a piggyback loan for an additional 10%. So it's almost like you put down your full 10% because the first mortgage is reading that you gave them that line of credit for 10% and then you put your down payment for 10%. So they're reading it as 20% down. In your case, you just put down 10%. And now you've got two loans. We call it a first and a second mortgage. So that's if you want to avoid putting down 20% on jumbo, but outside of that, 20% down is required.
Got it. I think that's you. That's the cameraman. Go ahead. Let me turn it.
Outside of that, there are a handful of other, I like to call gray area loans, outside the box financing, which is my favorite and my specialty. If you're self-employed and you don't really show much money on your tax returns, which most self-employed people tend to not do, understandably, but you have great credit, and maybe you have some outstanding deposits in your business account or your personal accounts from the work you do, we can do a bank statement loan, and we basically just qualify you off of the deposits in your bank account for the last 12 months. We calculate that, and that's going to be your income. Other options are for those that file a self-employed tax return and they receive a 1099. So maybe you file as a sole proprietor, a Schedule C, and you have your 1099, but you write off all your expenses. Mm-hmm. Well, us lenders, we look at your bottom line number when you're self-employed. So if you made $100,000 and you wrote off $60,000 in expenses and your bottom line number was $40,000, ouch, probably not going to get you too far with qualifying for anything. But we do have programs in this outside the box programs where we can just use that 1099 for $100,000. We call it a 1099 loan. There are other outside the box loans called DSCR, and those are for investors. So if you're an investor and you're going to buy a property as an investment property to rent it out, we can go no documentation. You're not going to submit any of your taxes or anything like that. All we're going to do is you're going to have your 25% down. Ideally, you can get away with 20 if it works. But you'll have your 25% down, and we're going to order an appraisal on that property. And whatever the appraiser deems this property could rent for, let's say they can rent it for, that the property can rent for $6,000, then your new monthly payment on that property needs to be $6,000 or less, and you qualify. So the investor just wants to know that you can cover the payment with the rental income, and the property is yours. So there's a lot of options. There's a lot of outside the box options that can fit various amounts of income, people, different situations. I think that kind of covers it. So that's as good as stated income kind of basically gets. There's no such thing as quote unquote stated income. That's really hard money, which you want to avoid.
Right. And I think it's important to be able to sit down after like going through, let's say you get I send you somebody who needs your help. I mean, you go through the application and then you help them step by step.
Right.
Right.
Yep.
And then
we
figure
figure
that out.
Yep. What their best move is.
Okay.
And it might be a few different programs, and we kind of just, do a side-by-side comparison as to like what works best for them.
And what if they're just like, you read it and you're like, yeah, you're just not ready yet. So do you help them?
Yes. So then we just put a game plan together.
Okay.
And the game plan could be 6 months, could be a year,
Yeah.
right? It just kind of gets you either saving, working on your credit,
Right.
kind of gets your wheels spinning on purchasing. Some people are a little fearful of it. I'm more of a dive in headfirst type of person. But I'm very knowledgeable. I started buying properties when I was 19 years old. And at that time I didn't have any credit. I didn't have a car payment. I didn't have credit cards. And when I bought my first property, my lender at that time ran my credit, and he's like, "You've got none." And so I said, "Well, I've got all the savings, and I did well financially for being a little 19-year-old." And he said, "Well, why don't you have your mother place 3 of her long-term credit cards that she's had in good standings, add you as an authorized user?" And she did, and literally within 3 days my score shot up from a 660 to like a 770, and I was able to close on it by myself. So there's always an option. There's always a game plan. I think it's more of a matter of just working through it, speaking about it,
them,
desking your scenario, and then figuring out what your best route is.
Well, and I think this is what's so important now, getting a pre-approval beforehand, because I know a lot of buyers are like, no, I'm just kind of looking. And I think it's going to make you really irritated if you're looking and you think that you can buy something for, let's say, $1 million, and now you can't, or maybe you could even do more and you had no idea.
Right.
So to get like the education behind it, get the pre-approval, and then be able to go out and look at that.
Yeah.
And I could talk all day with that credit card thing. I did that for my kids too.
Oh, really?
Yeah. At that early age, because I'm like, you can have their credit perfect.
It shoots it right up.
Yeah,
there.
so it's interesting. So
and credit is everything, right? Credit allows you to borrow money on a low scale, on a very cheap scale, right? If your credit is poor, you're going to be paying more money, any which way you slice it. So I always recommend that you monitor your credit monthly, and your bank should give you something like that. You have access to free credit reports annually. So I would always just watch your credit report and make sure nothing hits it, like a medical collection or a parking ticket. Because once those things hit that you kind of might have just passed up, it crushes your score. So keep taking a quick peek.
Yeah. Okay. Well, thank you so much, Yasmin. And we will talk to her soon. Bye.
Bye.